I guess I'd spent a lot of my teenage years playing SimCity and other games like that. Research was seen almost as back office.
Non-fee generative.
Yeah, it wasn't seen as a business development tool. If we look at Europe as a whole, the first half of the year, I think, is going to be a little bit lower than where we were expecting it to be. We can say that actually, around a third of the second-hand supply is probably unfit for purpose. Manufacturing-related take-up is at the highest it's ever been. And that's the headline that's been in the press. But again, important to get under the skin of the data here, because I think the biggest risk to the market is not necessarily on the supply side, overdevelopment, vacancy getting out of hand, anything like that. I think it's probably
Kev, welcome to the podcast.
Hello, thank you for having me.
Not at all. Real privilege and a real honour that you're sat here today. And I'm really excited to find out a little bit more about your background, your journey, but crucially, try and garner some of those insights from you about how you see the industrial and logistics market in the UK and Europe. And no doubt a lot of listeners to the podcast are keen to learn a thing or two as well. But before we get on to some of that good stuff, can you just rewind the clock and tell me about chapter one and how you got into real estate in the first place?
So it's an interesting story. I studied geography and town planning at university in Cardiff back in the year 2000. I guess I'd spent a lot of my teenage years playing SimCity and other games like that. So I got into that, and a lot of my friends went into real estate. I chose to do a master's in something called GIS. GIS is Geographical Information Systems. So basically the visualization of data to do with the built environment, or demographics, or other economic indicators, whatever it might be. I ended up doing my master's dissertation on the use of GIS in logistics supply chains. It was sponsored by the Ordnance Survey. Roll forward a year or so, I'd moved to London and I was selling software that lots of real estate companies used for GIS mapping, that sort of analysis. I was trying to sell the software to Attis Real, who later became BNP Paribas Real Estate. They saw that I'd studied the use of GIS in logistics and supply chain. And they said to me, well, we don't want the software, but we've got a job going in our research team. Would you like to apply for it? I did. And the rest is history. And that was almost 20 years ago now.
So you went into a sales role off the back of your GIS work. What were you selling specifically, and what were you in charge of?
So we were selling two things. We were selling GIS software, so mapping tools, and we were also selling software into the logistics industry to help logistics companies, retailers, whoever, plan their routes more efficiently. So the software was used by anyone, who had a business problem to solve. It could have been a marketing issue. It could have been a real estate issue. It could have been, customer profiling, whatever it might be. In the real estate sense, GIS historically was probably first used in the retail sector, to profile demographics and shopper spending and footfall and things like that. So, so it was quite varied. And, looking back, this is exactly the type of analysis, that I was selling, that people needed to be using. So that's an interesting way in, I guess, to real estate.
So you did, if I'm not mistaken, 2.5 years or so doing that before you actually flipped and you joined BNP
Yeah.
Paribas. Talk to me about that move and what did you do at BNP?
So at the time, Attis Real, before they were BNP Paribas, they'd been acquired by BNP Paribas at that time. They had also just acquired an agency called Fuller Pizer. Fuller Pizer was well known in the industrial and logistics space in the UK. They were involved in lots of high-profile deals, planning, business rates, a whole myriad of stuff. So they'd been acquired by Fuller Pizer, by Attis Real. Fuller Pizer were also very innovative. They'd done some work in the 90s, looking at the future of warehousing, and were really kind of ahead of the game, even back then. And they were also very innovative because they'd employed a supply chain consultant to advise their clients. The view being that if we could advise occupiers prior to them needing real estate services, then we stand a greater chance of advising them on their real estate services. They were also fairly innovative because they were also twin tracking this research post that effectively they kept as a live requirement when they were acquired by Attis Real. So I ended up applying for the job and got it, and really I had no idea what I was getting myself in for. I knew that a lot of my friendship circle from university had gone into real estate. They were working at places like JLL, Cushman's, other investment houses, and so on. So I knew a lot of my friendship group had gone into real estate. And what I realized really was that research was seen, and we're talking 20 years ago here, research was seen almost as back office.
Non-fee generative.
Yeah, it wasn't seen as a business development tool. It was seen as more, analysis, backwards looking. All of that stuff is important, of course.
But it would support the investment or the leasing teams in terms of their advice and how they went about their business.
Yeah, exactly. But I guess what I realized, with my salesy background, was that, I wanted to be telling people about the work I'd done and showing them and explaining it and trying to innovate in some way. And again, I was really lucky. Some of the guys there, Steve Williams, who was former head of agency at both Attis Real and subsequently Lambert Smith Hampton, and who has since set up his own successful practice, and Lisa Fitch, who was the supply chain consultant. Between the three of us, we were able to, start using research as not just an analysis tool, but a business development tool. And then when you brought in the capital markets side of things as well, so people like Ed Cornwell, who were in the capital markets team at Attis Real at the time, between capital markets, agency, research, supply chain consultancy, we were able to offer a view on the market to our clients that was hopefully interesting, and another way of looking at it.
So your clients, were they the CIOs of kind of the private equity funds, investors, developers? Or?
Back then, 20 years ago, the market was slightly different in my opinion. Obviously, you had some of the major developers who are still active today: Prologis, Segro, GLP, who were Gaisley at the time. Goodman. So you still had those developers who were specialists in the logistics and industrial market, and they were our clients. But most of the capital was UK institutions, the likes of L&G, M&G, LaSalle, AXA. These more traditional pension fund style investors. It wasn't probably until later into the noughties, that we saw, real overseas capital and different types of investors, coming into the market. So we spent a lot of time, with those, UK institutions, I'd say, talking to them about the markets and so on.
Talk to me about the evolution or the journey that you kind of went on from research being seen as like a back office function through to working together kind of cross-departmentally to then, pushing research a bit more to the front and using it as a business development tool to inform decision making. Talk to me about how you went about doing that and the journey you went on to get it in the hands of the clients.
I mean, look, I'm not alone in that journey. If I look at the agency research teams in particular, competitors to Savills, everybody was doing the same thing. So I wouldn't say I was necessarily innovative in that way, but what I was very lucky, I think, is because I could stand up in front of an audience. My agency colleagues, really put a lot of trust in me, to say what I wanted and have ideas be accepted, to get in front of an audience. So whether that was at conferences, whether that was one-on-one presentations, meetings, etc., etc. The other thing I think that was very beneficial is because of my fairly recent academic background, having done my master's dissertation about the use of GIS, and data manipulation and all of that, I was able to, to get my hands dirty in terms of data, and I think this is really important because as a researcher, data is the spine of everything we do. Data in all its forms, data on real estate markets, data on economic indicators, demographic indicators. Over the course of my career, I've done a lot of surveys, and that brings a different type of data, to the toolkit as well. But fundamentally, I was very happy to spend some days, locked away, looking at spreadsheets, trying to pick out what I felt was interesting. And then other days, we'd be writing about that. And then other days we'd be talking about that. And so, that role in research, particularly agency research, I found suited my skill set.
Yeah, and quite a rare skill set of being able to the sales, the interpersonal skills combined with the deep research and attention to detail and methodical nature that you'll need that comes with it. When did you start specializing in industrial and logistics as a subsector of real estate?
From day one. So I was brought in as a logistics and industrial analyst. So that was the plan, and I had a background in logistics loosely, from my master's studies and some of the work I'd done, during my master's studies, and yeah, so the plan, from the get-go with Atisreal was, focus on the industrial and logistics market. Now, clearly I didn't have a background in property. I hadn't studied real estate. Um, so I had to get up to speed fairly quickly, on how leasing markets work, on how capital markets work, and the motivations of the stakeholders involved, and so on. And that was a fairly steep learning curve, but I had great people around me. The head of research at Atisreal at the time, Keith Steventon, was was a real mentor to me, and and other people were just very willing to give up their time and expertise, to help me, which was fantastic. We did a piece of work in those early days called the Warehouse of the Future, which was effectively a big survey, and with commentary from various stakeholders. And I remember speaking to Paul McNamara, who was head of research at M&G at the time. I didn't know him; I'd never met him, but he was a research deity, set up the research function at M&G, and so on. But Keith knew him, and Keith opened that door for me. I said, I've got this idea. Will M&G contribute and speak on an event and all the rest of it? And people were just very willing to help. And you know what, as well, if I look back over the 20 years. For the most part, I've only had good news to give people. The market has almost constantly always been growing. If we look at the time when I first started, we were coming out of the GFC. Online retail was starting to take off, particularly in the UK. So even Brexit, when that came along, arguably had a positive impact on the UK industrial and logistics market. Roll forward another couple of years, you've got the COVID pandemic, and again, notwithstanding the trauma that brought to a lot of people on a personal level, the industrial and logistics market, exploded. And so it really was only, into 2022, that we had to start looking at things slightly differently because the news wasn't as good. So, so it certainly helped over the years that, 9 times out of 10, when we were knocking on the door to present our research, it was fairly good news. And, the same couldn't necessarily be said of the office sector and the retail sector over that 20-year period. So, so I do look back and think, I've been very lucky, to have a good story to tell, because that's part of the role of a researcher, to tell a story with the data that you have available.
Talk to me about the move to Savills, because you've been there just over 11 years or so.
Yeah.
Why did you move to Savills, and then give me an overview of what you've been doing in that period?
Like anything in real estate, it starts with people, and some of my agency colleagues and valuation colleagues had moved across to Savills from Atisreal at the time, and I got a phone call saying, would you like to meet up and have a chat? What's this about? So I did, and there was loose talk about what Savills' ambitions were in relation to research and industrial and logistics research, which sounded interesting. Matt Oakley, the head of research at Savills, to this day, Matt contacted me, and we went to Finos, which many in the real estate industry will remember fondly. And yeah, we talked, and Savills were very keen to bring in somebody who could focus solely on the industrial and logistics sector. And, they thought I might be able to help them. And eventually I met with the agency team, Richard Sullivan, Max Merriweather on the capital markets side. And we all decided it was a good idea. And so I joined 11 years ago and have loved every minute of it since.
Talk to me about the market today as we sit here in July 25. What's your take on the industrial logistics market? And I'm deliberately keeping that question quite broad.
Okay, so let's look at this in a number of ways. Let's look at the UK. Let's look at Europe. Let's talk about leasing, and then let's talk about capital markets, and then let's talk about geopolitics.
Perfect.
Usually, when I talk about this, I'm presenting for 45 minutes, so I'm going to give you maybe the 4-minute version, and then let's see where we go. Let's talk about the UK first, because we just released our UK report, and so there's lots to go out there. If we look at the occupier market first, take up is doing reasonably well. 14.7 million square feet of take up in the UK logistics market for the first half of 2025. That's ahead of the second half of 2024. And it's ahead of where we would have expected it to be if we look at what take up would have been pre-COVID. So what's interesting in the data, there are a couple of things for me that really stand out. The take up of existing buildings, so whether that's been a speculatively constructed building or a second-hand building, the take up of existing buildings is really strong, and that's increasing. Where take up has fallen in the UK is the build-to-suit side of things. Build-to-suit, design and build, turnkey, various bits of terminology that people across the world use for a more bespoke building. Where take-up has fallen relatively dramatically is in that build-to-suit segment. You have to go back to 2013 for a lower first half of the year when it comes to build-to-suit. Now, why is that happening? A number of reasons, in my opinion. One, partly it's a capital markets issue. If we look at exit yields, if we look at land values, if we look at rents, if we look at build costs, if we look at a whole myriad of those factors that would go into an appraisal, which I'm not expert on, but nevertheless, if we look at those, those are quite difficult equations at the moment. Then, if we look at the supply of existing buildings, the conditions are probably as tenant friendly as they have been for the last 10 years. Moreover, occupiers want to be operational quickly. They need to be in. They need to be doing what they need to do, and not necessarily waiting for 9 to 12 months for that building to be operational. Also, generally speaking, build-to-suits are bigger. They require a more expensive fit-out. So my hunch is that occupiers are looking at this and saying, well, actually, if we look at the maths around this, a build-to-suit, if we look at the cost of the fit-out, if we look at this, if we look at that, actually, for the time being, it makes sense to go into an existing facility. All of that being said, if we look at the second half of the year and what we know to be under offer, actually, I think it'll tick up. Not by a huge amount, the build-to-suit, but I think it will tick up. And one of the reasons for that, I think, is that we've done a lot of survey work. We do our logistics census every year. We do have an in-house Savills survey of all of our agents from across the world. And then, broadly speaking, the messages are pretty similar. Occupiers aren't necessarily in growth mode. They're more in strategic thinking mode. So they may have a lease event. They may be trying to reorganize their supply chain for whatever reason. It could be labor, energy, nearshoring. And so the requirements are more strategic in nature. And so those build to suit requirements are almost being drip fed to the market. Take the UK again. The fly in the ointment, I think, is that even with robust take up, we're still seeing vacancy and supply rise. And you have to go back to 2010, I think, for supply to be as high as it has been. Now, we had 9.5 million square feet of speculative completions in the first half of the year. There's broadly the same due in the second half of the year. So it's my suspicion that the supply and vacancy position is going to be fairly stable in the second half of the year. We're not going to be in a position where supply and vacancy trends back down to where it was during the pandemic. That position is a while off, in my opinion. Now, that doesn't mean we're not seeing rental growth. That doesn't mean we're not seeing, we don't think it's a good idea to continue building spec, because as I've said, as we've started, data is the spine of everything we do. And arguably, it's relatively easy talking about property markets in a rising market. Where data becomes absolutely paramount is in a market where it's not obvious what the right thing to do is, where it's not obvious that, all warehouses are good warehouses. So if we get under the skin of our data and start looking at different geographies, different subgeographies, different size bands, different grades, all of this type of stuff, if we then bring in our requirements data, if we then bring in our lease events data, if we then bring in our data on the land supply, all of this type of stuff, then you can really start to build a detailed picture of which markets are more attractive or less attractive to develop or invest in. So that's the UK. Europe. So I started covering the European logistics market about 5 years ago. And I am 43 almost in a couple of weeks. When I am presenting on the European market, my kind of opening gag, which people will be almost bored of hearing now, but my opening gag is that it will take the rest of my career to have as good data than we are blessed with here in the UK, and arguably the States as well. So the data on Europe is less available. It takes longer to arrive. It's less granular. We don't get the same level of insight on a line by line basis, and there are many reasons for that. The maturity of the markets, the way the agency markets work, the availability of secondary data suppliers, the lack of public data. Germany, doesn't have the same level of digitized land registry, for example. Certain markets are only really 10 to 15 years old, in terms of their maturity, parts of Eastern Europe. So it's going to take a long time for me to be able to rattle off, an oratory on the European market in the same way that I can on the UK market in isolation. Nevertheless, we are able to track take up, supply, vacancy, rents, all of those sort of things. And broadly speaking, if we look at European markets, we think that take up for the Q2 is going to be about 5% up. Now, if we look at Europe as a whole, the first half of the year, I think, is going to be a little bit lower than where we were expecting it to be. And probably that has a lot to do with what happened on April the 2nd, and the potential impact of tariffs, because that situation with the EU still hasn't resolved. Whereas for the UK, we've signed our limited trade deal, or whatever we're calling it, but there is an element of certainty now. Whereas in Europe, that hasn't been fully addressed yet. So we're seeing some interesting things there on the take up side. On the supply side, we're seeing the vacancy rate at the end of 2024, it had started to come down as a blended average. First half of the year, it's gone back up again, not by much, a little bit, about 50 basis points. But that's driven by the same reasons: speculative completions, second-hand supply coming forward, and that take up being just a little bit lower than we would have expected. So for me, on Europe, the key data points are going to be take up and supply in Q3, because hopefully we'll have a clearer steer on the tariff position at that point, and we'll really start to see how occupier behavior is reacting to what goes on. Now, the problem is, I talk about Q3, end of September, beginning of October. The reality is, for data on Europe, because of the reasons I've already highlighted, the data on Europe is probably going to come in about 6 weeks after the end of the quarter. So it's really going to be, not until mid-November that we really have eyes on some of those indicators. And so when I'm talking to clients at the moment, talking about the impact of tariffs, data-wise, it's very difficult. We can talk anecdotally and sentimentally and talk about the sentiment in the market, but because of those lags on some of the real estate data metrics, we're not going to have a clearer picture until much later in the year. And then that obviously has knock-on consequences into how people are considering their investment decisions, or in development decisions, or whatever it might be. So I said that was going to be 4 minutes. It's probably longer, but we'll see.
How do you segment, because that's holistic overview of the UK and Europe? How do you the industrial and logistics market, how do you kind of categorize it? Because there's lots of different subsects within that, and that overview you've given, is that just like a blend across everything from multi-let all the way through to big boxes and mid-box?
So primarily, when I'm talking about the market, I'm talking about bigger box logistics, units over 100,000 square feet, 10,000 square meters. And so really that's what we're talking about. And there's a number of reasons for that. One is data. I've already talked about how difficult it is to get data for logistics, let alone, if we start talking about the smaller ends, multi-lets, urban logistics, last mile, whatever terminology we're using. So that data, the market has good pockets of data. Savills and our competitors will have really good data on, Paris, Barcelona, Madrid, Milan, all of that type of stuff. But again, generally speaking, and this is even true in the UK, but generally speaking, the smaller you go, the harder it is to have granular, real-time data on on the market, and historically, with industrial being, the ugly duckling of the retail sector, it's been under researched for so long. Central London office markets, Paris office markets, the data will go back to the 70s, the 60s, if not before. Whereas logistics, industrial, we only really have 15 years of data, and that's just the way the market has matured and so on. So when I'm talking about the market, I'm really talking about industrial and logistics. Now, in the fullness of time, the industry, and as as I keep on saying, there will be competitors to Savills who are more advanced in some markets, but less advanced in others, and so on. So if I talk about the industry as a whole, I think over time we will start to see more sub-classifications and more stratification. We'll be talking about logistics, we'll be talking about multi-lets, we'll be talking about urban logistics, we'll be talking about cold storage, we'll be talking about self-storage, we'll be talking about data centers, which I'm not an expert in, but often crosses my desk, because a lot of the land is similar. So I think as time progresses, we'll see much more segmentation within the sector, but that's going to take time.
Property is a people business, hence the name People Property Place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. How forthcoming are investors and developers with their own in-house data in terms of providing that to you? Or is it a case of you having to track, hunt down, and try and originate as much of that as possible?
Let's start with the UK, and then I'll talk about Europe. In the UK, Savills, is in a very fortunate position. One of the market leaders when it comes to industrial and logistics in all its forms, whether it's agency, capital markets, planning, project management, etc., etc. So I always say that, as a researcher, you're only as good really as the agents you work with and their market knowledge and connections and so on. So within Savills, there is a lot of data and information flowing around that allows us to build that picture. And our landlord clients, are able to share information when they're able, which isn't always the case, NDAs or whatever it might be. But as, generally speaking, through the Savills network, we can establish a very clear picture of what's going on in the market. Into Europe, because that market matured, I guess, after the UK and evolved in a different way, in a different pace, we see a lot of engagement with the developers, and there are lots of data sharing clubs that exist, and and I guess that camaraderie, to help build a clearer picture on the data. And that's not to say that doesn't happen in the UK, but because the market is more transparent, full stop, it's all evolved in a slightly different way. So, it's in everyone's interests to have better data on the market. and generally speaking, landlords and investors, developers are forthcoming.
Has there been anything that has been particularly surprising throughout your research this year, that has kind of taken you back? Obviously the data doesn't lie. Is there anything that's kind of stuck out?
Well, the one metric that is interesting is that we're continuing to see the level of second-hand supply increase, really to levels that we've not seen for a very, very long time, 10, 15 years.
And is this good quality refurbed secondhand buildings, or is it?
Well, so therein lies the issue about getting under the skin of the data. Because if we just take second-hand supply as, one line on a graph, you can see this line going up and you go, there's a lot of second-hand supply here. What's really important to do is to get under the skin of that data and, establish, how good quality is it? Is it grade A, grade B, grade C? What's the height of the building? The eaves height. Because that's really important now for occupiers. Is it a good quality location? What's the EPC, BREEAM? All of this type of stuff. So if we do that, broadly speaking, we can say that actually, around a third of the second-hand supply is probably unfit for purpose, for modern occupiers. So it's important to make that point that, you see lines on a graph and you see a line on the report, but what's really important is to get under the skin of that data. And that's what we do, when we're one-on-one with our clients, when we're writing, reports for our clients. The stuff that we release to the market is the headlines and the analysis. But when we're in the room together, that's when we can really get under the skin of the data, and help our clients make those investment decisions.
Is in terms of what's driving that, is that if you think about what we're in 2025, the market is really hot. So I'm led to believe in 2018, 2019, a lot of people kind of piling in, allocating a lot of money into the space. Is that a case of cheap debt, refinancing pressure? We kind of need to get it off our books. Is that what's driving some of this, increased supply that's coming into the market? Or
no, the supply coming back to the market is not really a capital markets issue. It's an occupier issue. So if we look at the market at the minute, the net absorption is either fairly modest or negative. So, what do I mean by net absorption? Effectively, and there are different definitions of net absorption, but essentially we're looking at the difference between move-ins and move-outs. So
if I were talking about it from an occupational perspective rather than a capital and investment perspective.
Exactly, yeah. So we're looking at the difference between move-ins and move-outs. So whilst I've been saying to you today, the take-up, particularly of existing buildings, is strong, which it is, but we're still seeing the supply rise. And if we go back to some of our survey material that I mentioned, our logistics census and Future Space, which is a project we do with Tritax here in the UK, if we look at those metrics, what occupiers are telling us jumps out really clearly in the data is that they're not necessarily in growth mode at the moment. They're more in strategic mode.
Which is what you said earlier.
Yeah.
It's that consolidation and being a little bit more planned.
Exactly. So whilst we're getting the strong take-up, often what that's doing is resulting in a building coming back to the market. So that building might be 20, 30 years old. It might be newer. It might be in a prime golden triangle spot. It might not be. So there will be a lot of metrics and analysis that our clients need to do to decide what to do with that second-hand supply.
Yeah, rationalization, I guess, and portfolio optimization in terms of how they build and maybe absorb some of that, national insurance increase or just the wider economic challenges and deal with their operations moving forward.
Yeah.
How do you have any data in terms of the changing nature of the occupiers? And is it more 3PLs? Is there a bit more of an arms type background occupier moving in? Is it Chinese fronted to avoid tariffs? Is there an occupational story or a kind of a change that you've kind of identified or you can see in terms of the types of occupiers that are taking space?
Yes and no. If we look at the types of occupiers taking space, one of the stats that I always say, and your listeners will probably roll their eyes when they hear me say it again on this podcast, is that broadly speaking, 2/3 of occupier demand relates to the retail sector in some way, shape or form. So whether that's an online retailer, a high street retailer, a logistics company serving a contract for a retailer, a parcel delivery company, whatever it may be, broadly speaking, 2/3 of occupier demand relates to retail in all its forms. And that is fairly static, even over the 20-year period that I've been analysing the market. Now, if we look at 3PLs, give or take, account for about a quarter of the market. And then manufacturing, again, in all its forms, whether it's actually doing an element of manufacturing or distribution for manufacturing spare parts or whatever it may be, food production, automotive, roughly speaking, manufacturing related take-up is about 20% of the market. But proportionally, that's been increasing over the last 3 years. So there are two things here. So proportionally, manufacturing related take-up is at the highest it's ever been. And that's the headline that's been in the press. But again, important to get under the skin of the data here, because 30% of a smaller pie is not an increase in take-up in absolute terms. So one of the ways, to analyze the data is spilling out that manufacturing is really booming. Another way is it's not quite showing that type of analysis. Nevertheless, if we look the Savills occupier teams from across the world, if we look at the tenders they're being asked to complete, if we look at the type of corporates that they're pitching to, there is a definite trend for manufacturing related corporates from either Asia Pacific or the States looking to come into the UK and Europe. So this is stuff that our occupier team, mandates they're trying to win, and all of that type of stuff. So if we look at nearshoring, as a buzzword for the market, this has been huge over the last 4 years, as we really got to grips with the post-COVID environment. What I think we will see in relation to nearshoring, reshoring, friendshoring, best shoring, whatever terminology we're using, I think this is going to be a multi-decade driver of demand for the industrial and logistics market across Europe. And why do I say that? Because these occupiers, these corporates, are looking at a whole myriad of factors. They're looking at the cost of land, the cost of labor, the cost of energy, government subsidies, whatever it might be. And again, big strategic decisions about where they're locating. Are they actually manufacturing, or are they just distributing what's already been produced? If they are doing heavy manufacturing, then that's going to create a supply chain ripple effect in the hinterland of where they choose to set up. So that's going to have a big impact on our, investor developer clients for where they choose to develop and invest. But in my mind, we are seeing this in our data, and there are examples of this happening. But if we take that kind of blended pan-European view, this is going to be something that evolves over a long period of time, that has a incremental impact on the market, and is not the explosion of take-up that we saw relating to online retail, because ultimately online retail was business to consumer, and we all wanted our stuff really quickly, and the customer is always right. And manufacturing related take-up is more strategic, it's business to business. And so, you're reorganizing supply chains, you're reorganizing shipping routes, you're reorganizing, all of this type of stuff, big capex investments. So it's going to be a slower process than compared to retail and fast fashion and all of those type of stuff, which is much quicker and fast moving.
What does your data say around kind of innovation within the industrial logistics market? Multi-story sheds has been something that's been mooted for a number of years that I've picked up on. We touched on it earlier. Data centers, power. Where does this fit into some of the research?
That's a tricky one from a data perspective, because, by definition, something that's new has no data about it, really. So, so we have to think about these things in a slightly different way. But ultimately, something like multi-story, multi-level warehousing, similar to what we see in Asia Pacific, comes down to supply, demand, viability, construction cost, fairly normal indicators, and one of the first pieces of bespoke research I did, a commission from a client when I first joined Savills, was about the evolution of multi-story warehousing in Asia Pacific. And so I worked with the Savills research team in Hong Kong, in Tokyo, in Singapore, to look at how, the market evolved for the multi-story warehousing. And ultimately, there are three things: rising land values, rising population densities, and also, planning policy effectively mandating it, in terms of, intensifying the use of land. So if we turn that back to London, we've seen rising land values, we've seen increasing population, and the population of London is only forecast to grow. And so the pressure to build housing and industrial land, will often be seen as an area where residential can go. And so, so we're going to see those similar metrics in many European markets that Asia Pacific had as well over time. And then, we talk about planning policy. Now, again, I'm not a planning expert. There are people much more qualified to talk about, planning policy and its impact. But ultimately, if you look at things like the London Plan and so on, intensification is something that comes up time and time again. So I think in the fullness of time, it will be commonplace for multi-story warehousing to exist in European markets, where supply is tight and all of those things, that Venn diagram aligns. But from a data perspective, it's really tricky. Take certain parts of London. We've had multi-story schemes come across our desk at Savills. The one thing you can't do is control the phasing of a build. So historically, an industrial estate, a logistics park, you could build phase one, you could build phase two when phase one has let, and you're drip feeding the supply into the market, because that allows you to control vacancy rates, and vacancy rates will ultimately impact rental growth. So if you start building multi-story, you can alter the supply dynamics quite dramatically just in one.
Because you just bring in a load of supply.
Yeah,
at the same time.
you can't
Drip
really
feed.
you can't really phase it unless some of my building colleagues tell me otherwise. So so there's different market dynamics there. And you could see vacancy rates in parts of London going from 2% to 8% in one fell swoop. So so a lot of planets have to align, and there will be better. I know you've had Paul Weston from Prologis on this podcast before. Prologis have done this all over the world, and and other developers will have a really interesting take on this as well. But from a data perspective, it's tricky. So you're looking at proxies, you're looking at markets across the world that you can draw from, and again, that's where I'm very lucky, because the Savills network is obviously global, so we can draw on the expertise of our colleagues across the world who have got some data and some experience to answer those questions.
What's the story when it comes to rental growth? Investors love underwriting rental growth, but what's the data telling us?
So it's really interesting on rental growth. If we look at data that goes back 20, 30 years, if we look at the relationship between the vacancy rate and rental growth, this isn't rocket science, but effectively, as the vacancy rate increases, rental growth decreases. So, that's supply and demand. If we look at the last 5 years, actually, if we look at the last 3 years, post cost of living crisis and so on, and we've seen the vacancy rate gradually tick up. What's been happening though is you've seen this disalignment between the relationship between vacancy and rental growth. So what we're consistently seeing is that even though the vacancy rate has ticked up, we're seeing rental growth ahead of where we would have expected it to be, given the vacancy position.
Supply and the demand dynamics.
Yeah. Now, why is that happening? Partly, it's indexation in leases, particularly in Europe. So inflation's been higher, so you've had higher rental growth. Partly it's been elevated build costs, price of steel, all of that type of stuff. And partly it's been, supply and demand, simple supply and demand rental growth. And partly it's been, the bifurcation in the market, where logistics being no different to any other asset class, occupiers looking for good quality buildings. So we don't really have the answer, but that combination of reasons has meant that rental growth has been higher than we would have expected to be, given the vacancy position. Now, if we look at the half year, in the UK, rental growth is still good, and probably by year end, we'd expect it to be coming in at around 4%, which is broadly in line with what our forecasts were at the start of the year. Into Europe, it's a little bit more muted. And almost you're in a position of rent stability. But and I stress this point, that comment is made as a blended European average. So it will be different in different markets. And what I always say, to people is, follow the vacancy rates, broadly speaking, because, are you more likely to get rental growth in a market where the vacancy rate is 2%, or the vacancy rate is 10%? So if we look at that blended European average of around 6.5%, there are still markets across Europe where the vacancy rate is hovering around 2%, whereas there are also markets where that vacancy rate is higher. But then if I say, well, look, take Spain, Madrid, the vacancy rate is hovering around 11%. Actually, again, that's all very well. But if you get under that vacancy rate in that market, you can see that different corridors, different rings are performing differently again. So, so when it comes to rental growth, two things I think are clear for me. As the vacancy rate starts to decline, which I think it will over the next 2 years, because we're seeing the development pipeline fall off a little bit, and we're seeing that existing unit tick up a little bit. So the vacancy rate is naturally going to come down. Then the rental growth should start that trajectory back up, higher than we would have expected it to be. Now, what we haven't got into yet is affordability. Is there an affordability ceiling for occupiers when it comes to rents? Now, London, has consistently been, one of the most expensive markets in the world to take space, not just in terms of rent, but in terms of, other, local taxes, service charges,
Labour.
All of those things. And our world research team recently put out a report that looked at this in more detail. And actually, in London, we've seen a period where renewals have been higher, and take up has been stable. Hasn't been growing dramatically. So, so there's some questions there, I think, about affordability, but London is at the extreme end of that analysis. If we look at other markets across Europe, and if we say that London is the high watermark, that would suggest there remains a lot of rental growth across Europe over the next decade.
Talk to me about AI, automation, in terms of what you're seeing from an occupational and investment perspective, but also the impact of that in your own work as well.
Yeah, again, really interesting question. If I take the logistics market first and talk about how AI could have an impact. So occupiers, logistics companies, retailers, manufacturing companies, will all be the same as anyone, experimenting with how they can use AI, to be more efficient and so on. Where I think, this is interesting is about how occupiers hold their inventory. And so I was lucky enough to have a tour of a warehouse facility last week. And the occupier in question was saying, well, through more advanced analytics and the use of AI, they are able to hold their product in their warehouse for a shorter amount of time, because they know that it's coming in and they know that it's going out, where it's going, all of that type of stuff. So they were saying, well, probably what this means is that we will need less warehouse space in the future. But actually, if you were a glass half full kind of guy, you'd say, well, that's not good for the logistics market, because here you have a corporate saying they need less warehouse space. But we're dealing with tangible products. If you sell cups, those cups have to be stored somewhere. And if they're not stored in your warehouse, they're going to be stored in someone else's warehouse. So ultimately, what AI may do is it will make people more efficient, but ultimately the product is going to be, it has to be stored somewhere. It's not an intangible thing. So ultimately, I think it'll be stored further down the supply chain, which will have consequences for where occupiers need to hold their space. Now, does further down the supply chain mean in a warehouse next door, and the agglomeration benefits of all of that? Or does it mean, in another part of the country, that bit we don't know yet. So I think, AI on logistics companies and retailers and manufacturers, will have an impact in terms of where they store their products, and how fast moving things are, and things like that. When it comes to research within real estate, a couple of observations. I think I've already talked about the scarcity of good data, particularly in certain markets across the world. So AI relies on good data, and so the availability of data, I think, is a real issue here, because the AI can only work if it's got pools of data that it can draw on. So on one hand, AI, what could it learn from? Because we're trying to aggregate all of this data that's taking a long time, and so on. So that's an issue that I see. But fundamentally, can we use it to improve our processes? Can we use it to speed up some of the analysis we do? Ultimately, yes, I think that will be the case. But again, any corporate is going to have to be very careful with how data is shared, and how, we don't want the data of our clients getting into the wrong hands, and all of this type of stuff. So there's a lot of stuff there to be worked through, that ultimately I don't have an answer to yet. So what it may allow us to do, if we think of my team of myself and 3 other analysts, what it may allow us to do is expand our coverage, look at different size bands, look at different geographies, look at different subsectors in that stratification that we talked about earlier. So freeing up our time to do more. But it's early days.
What's the biggest risk to the industrial logistics market at the moment?
I was asked this question recently by a client when I was on a panel at a conference, and the answer I gave was, I think the biggest risk to the market is not necessarily on the supply side, overdevelopment, vacancy getting out of hand, anything like that. I think it's probably, where does the level of online retail penetration stabilize? If I go back to pre-COVID and during the pandemic, we were all talking about, online retail reaching 40, 50%, so on and so forth. And I think if you look at the UK data now, we're hovering around, 27, 26 maybe. So broadly in line with the trend that would have been present had COVID not happened. Now, online retail is still growing. We're seeing new entrants into the market from overseas, and they have real estate requirements. We're also beginning to see online retailers move out of their first generation of buildings into more modern, buildings fit for their supply chain that exists today. So, how worried am I about that potential risk to the market? Not greatly, but I do think it's something that we need to be monitoring. How does this really play out? I read an article the other day about TikTok Shop. I'm not an avid user, but one of the interesting things that is creating is a returns bonanza that hadn't necessarily been anticipated. So so there's constant evolution there, but ultimately, how does that penetration rate stabilize and grow, not just in the UK but into Europe as well? I think is a risk factor we need to be thinking about.
What advice, if you were to sit down with a potential new entrant into the UK or European market, whether that's from the States, the Middle East, Asia, wherever it might be, what advice would you give them if they wanted to step into this market?
So, I think when we're talking to clients and potential clients, about entering the UK and European logistics market, I always start with the supply side. I always look at vacancy. I always look at land supply. I always look at lease events, development pipeline, all of these things. And there's a number of reasons for that. One, because generally speaking, we have good data on those metrics. But also, if we can get comfortable with the supply side, that is largely in our control. If we look at the demand metrics, population growth, consumer spending, GDP, online retail, which we've just talked about, those future drivers are just their forecasts. They could be right, they could be wrong. We don't know what geopolitical events are coming along and could impact those forecasts and how everything plans out. But what we do know is that the supply side metrics, we can really get forensic on. So if we can get comfortable with those supply side metrics and know that we're going to be developing the only warehouse in town, regardless of the demand side metrics, we can see that we're going to have a good opportunity here to lease it, to realize rental growth and capital value and all of those type of stuff. So I always say to people, let's focus on the supply side metrics because we can, we know this to be true. The demand side metrics, are the icing on the cake, which are obviously important, and try and marry those things together. But kind of like an 80-20 rule, I'd suggest to people, if we can focus 80% of our time on the supply side metrics, that's a good place to start.
As we draw to a close, a question I ask everyone who comes on the podcast is, if I gave you £500 million worth of capital, how would you allocate it?
Well, being the first researcher on this podcast, I want to take this question in a slightly different angle, a slightly different route. And, one of the things I've discussed at length today, is data and how data is the spine of what we do. And we use that data to tell our story. I've also talked about, the scarcity of data in some markets across the world. So I'd like to use that 500 million to have a team of analysts and to really, really, get some, a greater level of transparency. More transparency means more liquidity. More liquidity means more deals. More deals means more fees. And so data's our starting point. Now, a cynic may say to me, well, poorer data creates opportunities. And that would be true. Good market knowledge, good brokerage, good agency, involves, imperfect data to create value. And that would always be the case. But I would argue that more transparency, will bring the whole market up in together.
So 500 million, better data, better transparency. And then once you've kind of cracked that, you'd probably come back for a little bit more and say, look, this is the gap, or this is the niche that data is telling me where I would deploy some further capital.
That would be the idea. And what I imagine it would say, it would allow us to identify, markets with really low supply, low vacancy, what the development pipeline is, what the land position is, all of this type of stuff. 2 markets where we have fantastic data, UK and Poland. We did a piece of work recently. The Polish market is always tarred with the brush that it has too much land. Using the data that we had available to us, we were able to say, actually, guys, this isn't true. If we look at the land banks for logistics development, if we compare the UK and Poland and then look at the build-out rates, actually, Poland has less development land than the UK. And so we were able to dispel some of these myths that exist in the market. So that's one example of where the data allows us to share this insight.
People lie, data doesn't. Kev the Shed, as you're known in the industry, thank you so much for joining me on the podcast today and sharing a little bit about your background and journey, but also some data, some insights in terms of the wider UK and European market. I've really enjoyed it, and I'm excited to see what you and the team are going to do for the rest of the year.
Thank you for having me. It's been a pleasure.
Hey, quick one from me. If you enjoyed this conversation, do me a favor and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.